mortgages and amortized loans. We're going to start here with a simple example with only yearly payments on this loan. As you progress through this course, we'll move to monthly payments or quarterly payments, but I just want to show you how an amortized loan works today. So the goals for this unit, we want to understand the concept of an amortized loan. We want to calculate the payment required for an amortized loan. We want to be able to calculate the balance, interest paid, and principal over the life of an amortized loan. The reason we care about this is when we own things such as a house, the interest on our loan is tax deductible. So while a mortgage company will keep track of this for you, it's always good to be able to get an idea yourself before tax season arrives. It's also always good to know how much you owe on a loan. So when will you outright own an asset? An amortized loan is the idea that when you pay off the loan with your monthly or yearly payment, the payment goes to two places. First, you pay interest on the loan to a bank or whoever holds the loan for you. The second part of the payment is principal reduction. And when you add these two things up, it adds up to the payment. Now with an amortized loan, the payment is always the same, but how much you pay in interest and how much principal you reduce is always changing with each payment. The interest you owe is always based on what you currently owe on the loan. So of course, the first payment of the loan, you owe the most interest because that's when the balance of the loan is the biggest. As the loan progresses, you pay less and less interest and you pay down more and more principal. This is how an amortized loan works. Now let's look at an example. Hit pause and read through this example before we continue. So a couple just purchased a house for $100,000. The mortgage calls for yearly payments at a 10% APR over a 20-year time period. So we're going to make 20 payments to pay down this loan to zero. So an amortized loan, at the end of the time period, you owe nothing. So our first two steps here is one, we want to get the yearly payment on the loan, and then second, we want to see what the principal reduction is on the first year of the loan, for starters. Well, key principle here is the balance of a loan at any time is the present value of the remaining payments. So the day that we take out this mortgage, we have 20 years left to pay, so the balance or value of the loan is just the present value of 20 yearly payments. Now the loan is going to be $100,000. So if we take the present value of those payments at our interest rate of 10%, it will add up to $100,000. We use the present value of the annuity formula, where R is our rate, T is the number of periods for our loan or the number of payments, and the present value is our loan balance. You see below plugging into the formula. With a financial calculator, we would say N is 20, the interest rate is 10. Present value is our balance of $100,000. We always set future value to 0 on an amortized loan because we'll pay the loan off at the end. We compute the payment. When you solve for the payment, you'll get a negative in your calculator, but we get $11,745.96. This will be the amount we pay every year for the next 20 years. Now when you solve this on your calculator, you probably got a negative $11,745.96. This is just the calculator telling you that you're paying for this loan. Now for the 20 years, $11,745.96 is what you will pay every year. Now every year, part of that goes to principal, part of it goes to interest. So for the very first year, we can calculate the interest as follows. It's the starting balance times our yearly interest rate. Now if we were doing this monthly, it would be our starting balance times our monthly rate and so forth. Here we're going yearly, so our interest for the first year would just simply be the $100,000 balance we started the year with times the 10% interest rate, which adds up to $10,000. So out of our $11,745.96 payment, $10,000 of it is going to interest. So you're really not paying down much principal in your first year. And remember, paying down principal is the same idea as building equity or ownership in the house. So in the early stages of a mortgage, you don't build up much equity, in other words. So the principal reduction for the first year is just simply the difference, or $1,745.96. Now at the end of the year, we started the year owing $100,000. We paid down $1,745.96 in principal. So our new balance going forward is $98,254.04. We would carry this forward to year 2 and we'd start the process again. The interest we would owe would be 10% of $98,254.04, and we keep the process going. I've included here a full amortization table just to show you what one looks like. In this class we won't have to recreate this, but I want you to see this for just your future. When you buy a house and take out a mortgage, the mortgage company will send you an amortization or payoff schedule for your loan. So I want you to know what it looks like going forward. Now, what can we take for this for our life in general? Early parts of a loan, we pay mostly interest. Now, the good news is that interest is tax deductible on our personal income taxes. So you can have a large personal write-off and you can get a tax refund often when you own a house. Now, in recent times, some politicians have talked about removing this tax deduction or interest rate reduction. Think about how that would affect home buying in our country. And think about to yourself, is that a good or a bad policy? Something to think about for test time, perhaps. In the later phases of a mortgage, you're not getting as much interest charged to you because the balance of the loan's gone down, but you are paying off a lot of principal. So the life of a house is this: tax benefits early, ownership gains late.